Have you looked at SCHD's dividend yield lately? It's been climbing, and if you're like most investors, your first thought might be, wow, that's nice.
Nice.
Higher yield means more income. But hold on, because when dividend yields rise, it's not always a sign of strength. It could mean that the market is punishing the price, or it could signal a deeper shift in how SCHD's holdings are performing this high rate in a slow growth environment. Today, we're unpacking what's really going on with SCHD's yield, why is it rising, and how you, as a long-term investor, should read those numbers. We'll dig into the numbers, into the risks, and into the opportunity sitting under the surface. So without any further ado, let's dive in. So dividend yield as a calculation is pretty simple. It means annual dividend divided by the share price. So as an example, if SCHD pays you around $2.50 a year and trades at $25, that's a 10% yield. Now, if the price drops to $22 and the dividend stays the same, that yield jumps to 11.4%. That's essentially what's been happening at the moment. In April 2022, SCHD was trading at an adjusted price of $26 to $27. By April 2025, it's trading around $24. Meanwhile, the 12-month trailing dividend is approximately at $1.04 per share, which at today's price gives SCHD a trailing yield at about 4.27%. SCHD holds quality, dividend-paying U.S. companies, so think of Texas Instruments, Pepsi, Broadcom. These are not just speculative growth stocks. So why do we have this drop? Because it's also about macro conditions. We have high interest rates, dividend-paying stocks are less attractive versus short-term bonds at the moment, corporate earnings are under pressure, economic growth is slowing, and in short, the market is rotating away from value and income despite those same companies continuing to generate cash and pay dividends. But there is really more to the story this year. In March 2025, SCHD went through its annual reconstitution, and that reshuffling played a huge role in pushing the yield up. 20 new stocks were added, and 17 stocks were removed or deleted. And SCHD's energy sector exposure nearly doubled, going from 12% to over 21%. And that's really a big shift. Names like ConocoPhillips, Schlumberger, and Merck came in, and all of which tend to have a higher dividend yield. Meanwhile, some lower yielding or underperforming names like Pfizer and BlackRock were dropped. Even though the index yield technically decreased by 0.07%, the actual dividend payout from SCHD's holdings began to reflect this new lineup, contributing to the yield increase we're seeing now. So let's clear something up. A rising yield isn't always good news. It can mean two things really. First is that it's a great opportunity. The price is undervalued and the dividend is solid. Or it's a dividend trap in the making. The yield is high because the market expects the dividend to be cut. In 2025, this distinction matters more than ever. Even fundamentally strong companies are being cautious at the moment. With higher borrowing costs, tight labor markets, and inflation still sticky, businesses may start freezing or trimming dividends. Not because they're failing, but because they're trying to protect long-term stability. So we really need to ask ourselves, is the payout ratio creeping up? Is free cash flow keeping pace? Is dividend growth slowing or holding strong? SCHD's screening process is really solid, but it can't eliminate macro risk. And the sectors SCHD now leans into, energy, industrials, financials, are sensitive to economic cycles. So what do we do with all this? If you're a long-term investor using SCHD for income, here's how to think about it. First, try to keep a dollar cost average technique going. These lower prices mean a better yield on the cost down the road. Next, think about reinvesting your dividends. You're locking in higher yield automatically. No timing really is needed here. Track changes to SCHD's holdings. After this year's reconstitution, if you're not holding the exact same fund you were last year, stay aware of it. Next, try to focus on total return. Dividend yield is part of the picture, but it's really not the whole thing. SCHD's long-term returns include both income and price growth. And if the dividend yield gets trimmed in the future, that's not the end of the world. Remember, SCHD rebalances every year. One company's cut doesn't sink the ship. And here's a key point. While dividend cuts are always possible, SCHD's sector composition may actually reduce that risk because it's not overloaded with volatile tech stocks. Instead, it's heavily tilted towards consumer staples, healthcare, and energy, sectors that tend to hold up better during slowdowns. So for example, consumer staples, Coca-Cola, Pepsi, Altria, healthcare, you got Bristol-Myers, Squibb, Amgen. Industrials and energy, you got Lockheed Martin, ConocoPhillips. These companies provide essentials. Their cash flows are more consistent. And historically, they're less likely to slash dividends in a downturn. That defensive tilt gives SCHD holders some added peace of mind. So yes, SCHD's yield is up, but understanding why is the real edge here. This is not just about price drops. It's about macro pressure, sector shifts, and the reconstitution of the ETF itself. When you understand those things, you can stop chasing yield and start investing with more confidence. So really, that's it for this video, guys. I hope it helped. And if you did like this video, please leave a like and subscribe for more videos, more weekly videos breaking down ETFs, weekly trends, macro strategies, and how to build your wealth over time. Until next time, stay patient, stay invested, and stay smart.